Whenever you're in a buy program, what's a buy program? A buy program is where price is going to be one-sided. It's in the process of running to buy-side liquidity or a obvious premium inefficiency, which would be this, okay? Or the stops resting above here. Once we cross equilibrium, and now we enter into what? It's a premium market. But at equilibrium, while we're in a buy program or when we're bullish, it acts as a discount. When you are trading in a range, equilibrium when bullish is a discount. Equilibrium when bearish is a premium. It stayed within the context of that daily fair value gap. Then we started moving higher. New day opening gap. Equilibrium is this level right here. We have a down close candle. Close proximity to that, that means yes, this can be an order block to be traded to. You do not look at these down close candles as an order block. It's not. They are not a bullish order block. ICT, why don't you look at that down close candle or those series of down close candles, and why didn't you look at that as a potential for the trade down to and create as a order block? It's relative to the dealing range you're trading in. What's the dealing range? The high and the low. Why is that a dealing range? What's above this high here? Buy stops. It went above it and then traded lower. Where did this low go to? Just below that low right there. So what did it do? It took both sides of the liquidity. Do you see how the rules keep repeating? But you don't want to be looking at down close candles that are in a premium level above equilibrium. This order block returned back to equilibrium level or 50% mark of the high and the low, that dealing range. So when it trades above it, yes, we are looking for that to support price. But now watch what takes place. Any down close candle after that, we don't care about referring to it as an order block because we're now in a premium. Once I get to a point where I have basically 60% of the position, or not position, but the potential unrealized range or target for the trade I'm trying to be a participant in, I stop adding. The hard line rule is once we get into a premium level at equilibrium or higher, I don't want to add anymore. For my own personal tastes, I do it just below equilibrium and I'll stop adding. The hardline rules are you can do it at equilibrium. But once we go above, if we have any situation like this, don't look at any down close candles once we're in a premium in a buy program where the market is predisposed to go higher to take out any inefficiency that's a premium level. This is premium because it's above equilibrium. So if you look at this is the high and this is the low. This inefficiency is where? It's in a discount. It's below the 50%. So that's not a target. So if this SIBI, if it's part of the sell side of the curve, this right here, once we cross over there, this becomes an inversion fair value gap. Light bulb moment, right? Oh my goodness, it's starting to make sense. So if we look at it like this, see how the down close candle goes right into the old inefficiency. Everything part of a market maker buy model, because that's what this is, has to match up with the sell side of the curve. Sell side of the curve is when a market maker buy model, it's the initial down run. And then the market claws its way back up to clear out the original consolidation and go above it where the buy stops are going to be resting. This run here, look how it completely shoots up and re-delivers all of the sell side delivery here, all these expansive candles that are down closed. That thin price action, real quick sudden movement lower, it's replicated with the movement up. What does that tell you? That's a signature that you are absolutely going to see the buy side get hit. That's designed to be there. But this quick delivery and price action, that matches the quick delivery price action on the downside. So when I'm talking about I want to see certain signatures in price action, that's a signature. Just like I want to see when price starts to rally, every down close candle that offers a fair value gap, if you're in a buy program, you are not thinking, oh, I'm going to go up here and sell short into that, or I'm going to go and sell short into that, or it's going to go up to here and then I'm going to sell short into that. So you can see how once we got through it, both fast movement lower, fast movement higher, down. Look at the bodies respecting what? What is it respecting? The inefficiency. They drop it down. Where does it drop to? What's this level? That's equilibrium. So the market comes all the way back down into equilibrium, rallies, and then we blow out the highs.